All right. So yeah, so she was asking about LIBOR. LIBOR is a floating rate. Please read up on it. And there's also a famous LIBOR scandal because it's fixed by the banks. Okay, the rate is actually fixed by the banks. So try and read up on the LIBOR scandal. It basically it's not a traded price. Okay, it's an indicative price, and it was basically, and the banks were rigging the price because they wanted to make money on their derivative transactions. It's a major scandal. One guy is still one UBS and Citibank trader. He's still in jail in London. So the UK has very strict penalties for these kind of white collar offenses. So read up on LIBOR, and I've given you that link. And now so they've changed it to ICE LIBOR, and there's also a new floating rate benchmark that is coming up that is called SOFR, Secured Overnight Funding Rate, that's coming up in the US. Okay, so there's essentially the problem with LIBOR was that people were fixing the rate. So they were just, how were they getting the LIBOR values? They would just poll the banks in the morning at 11 a.m. London time. They would just poll the banks and say, okay, and what is the rate at which you are willing to lend to other banks in London at today for, say, Swiss francs, yen, Aussie dollars, US dollars, euros, sterling, all these currencies. They would ask them, and everybody would give their rates, and they would knock out the top and bottom rates and then just give you an average, and that would be your LIBOR. But what was happening is, because of this kind of method of fixing, some guys who wanted to make money on their derivative, and this is LIBOR is actually the basis for this thing that you see here. I don't think they've switched yet to SOFR. This Euro-dollar futures contract that you see here, which is GE, I don't think we have that here, but if we add that, we should have, how did it disappear? This is gold, right? Yeah, so this must be GE. If we GE Globex euro dollar. Okay, now this Globex euro dollar is basically this is the reason why I've always told you that whenever your intention is to refer to the euro dollar FX rate, you must always say euro dollar FX. Otherwise, there could be confusion with this euro dollar interest rate contract. It's one of the major interest rate contracts in the world, trades massive amounts of volume. This contract settles against the 3-month LIBOR fixing in London. This is the futures contract, and the underlying asset is the 3-month LIBOR deposit. Whatever is the interest rate. Okay, so they are huge. They're like trillions of dollars of derivatives contracts against LIBOR, and so many of the traders had an interest in fixing LIBOR because they knew they could manipulate it, right? So if I say that, okay, I go through the broker and I say, okay, you please tell Chuk to quote this rate for sterling, and in return I will quote this rate. Please tell Rajan to quote this rate for yen, and in return I will also quote a lower rate when you need it. So there was collusion among the various banks, because they were actually just taking the rate as, okay, what are you lending at today? So they were just polling the banks, and they manipulated the input that they gave. So this became a major scandal. Lots of lawsuits may be still pending. So this contract, the euro dollar contract, which is a major contract, this will settle on December 16th. So we can keep this. So you notice this is quoted as, you can read up. I've given you, this is part of your case as well, okay? But this is not part of your trading project, but this is part of your case. All right. So you should understand the euro dollar contract, one of the most important contracts in the world. Okay, later on, if we have time, in a subsequent project, because we don't have enough money, enough capital in this account to trade everything. But ideally, we would trade this also. We would also trade. Yeah, we'll put this down. Okay, so you notice how the euro dollar, let's discuss the euro dollar contract a little bit, okay, while we are on this topic of LIBOR. Okay, so a little bit unplanned, but doesn't matter. That's how it is. That's how it should be. Okay, we go based on questions. Okay, so is everyone following the discussion? Okay, why are we interested in LIBOR? Because we are, in our case, we have said that we see this loan here. Okay, we see this US dollar loan here, 100,000. Okay, and when you read the case, you see, so on this loan there is no interest rate, there is no foreign exchange risk, because their revenues are in US dollars and the liabilities in US dollars. But there is interest rate risk, which we find out when we see this thing in the case. What does it say? It says that there are loans in yen, Aussie, and US. Okay, and then later on when we read the questions, we find that the dollar loan has a 5-year maturity, and the interest rate is linked to 3-month LIBOR. Okay, ICE LIBOR is only because ICE is an exchange. It used to be called the Intercontinental Exchange, but now if you just go to theice.com, okay, you'll get the link from here. If you see here, This is the ice.com. This is now they've just changed their name to ICE. It's a very big exchange, okay? Not as big as CME Group, but one of the very big exchanges. So they have the Brent crude oil futures contract, okay, while CME has the WTI futures contract on oil. So ICE is now taking care of the LIBOR fixing. Okay, so they have introduced certain safeguards, but they're taking care of the LIBOR fixing. So you can see here, so the main problem of LIBOR, so every day there will be a LIBOR fixing for multiple currencies. Now they've reduced the number of currencies. Earlier there used to be many currencies. Now they've, I think, knocked out Aussie and Canada and all that. Okay, so but there are going to be, understand the LIBOR fixing is going to be for multiple currencies, because just like when you look at HDFC Bank fixed deposits in India, it's not just one rate. It's 3 months, 1 month, 90 days, 180 days, whatever, right? So it's 1 year, 5 year, all kinds of maturities. For in any currency, whenever you're looking at interest rates, you have to mention the maturity as well, because otherwise it doesn't make any sense. Interest rate for what maturity? Okay. So every so that means when you're fixing when you're taking the LIBOR fixes, you are going to go by currency, and you're also going to go by maturity. So you start with US dollars, and you say, okay, give me the 1 month LIBOR, 3 month LIBOR, 2 month LIBOR, 6 month LIBOR, 9 month LIBOR. Are you following? LIBOR is nothing but the London Interbank Offer Rate, which is it's a borrowing rate. Offer rate, so it's not the bid. There's also a LIBID, which is the London Interbank bid rate. Okay, but less used. Okay, more commonly used is LIBOR, which is the rate at which the banks will lend to other banks in London. Okay, so every day, because you can compute this rate every day you can see the fixed deposit rates of any bank in India, right? So, and those days, if you start the fixed deposit on that day, if you start a 3 month fixed deposit on that day, it'll be 3 months from that day. Then tomorrow you go open another fixed deposit, it's 3 months from tomorrow. Okay, so every day you have an interest rate, and every interest rate per currency you have multiple maturities. So when you do the LIBOR fixings, okay, we can click this open and see whether ICE has been blocked. So they haven't blocked ICE. Okay, all right. So you can read about this. You can see all their markets. You can go. There's a similar scheme to the CME website, because they are a big exchange. They're also the owners of the NYSE. Okay, so you see their information there as well. You can see LBMA gold and gold and silver data. This is LBMA's London London Bullion Market Association. Okay, is LBMA. Okay, so you can see here that so you can see you can read about ICE LIBOR. Okay, now they're doing it only for these currencies. Earlier they had Aussie and Canada and all that. Okay, but now they've dropped all that. So this is the idea here. So you will be doing it for each currency, and then you can see 7 tenors. Are you following? You can see here the articulation of what I just told you. Basic concept: in every currency, interest rate, a statement about interest rates has no meaning unless you mention the maturity. Okay, so here you can see the way the LIBOR is fixed now is 5 currencies, and for each currency they're going to go for all these 7 tenors. Okay, this is clear. Read up more about it. Read about the LIBOR scandal, part of your learning. Okay, all right. So this is the problem here. In this case, if we go back to the interest rate, so this actually leads us to our discussion of the key risk factors. Okay, once again, so because the loan has a 5-year maturity, okay, and it has an interest rate index to 3-month LIBOR. It's a floating rate. We call this a floating rate loan. Okay, essentially a floating rate loan means that the maturity of the loan is longer than the period for which the interest is being reset. Okay, so if we can write this, I haven't written a definition of this. We can write this somewhere in your notes. Okay, so for everything we need to have, everybody understands what a floating rate loan is. Okay, in India also SBI has floated the idea, has toyed with the idea of, they even came out with it. I think now the regulators have banned it or something like that. They came out with the floating rate housing loan scheme or something like that, right? They had these teaser interest rates also. So we look at we can write it. Where do we write it under? Let's write it in your session outline. Okay, so under 612 we can write. So you notice that you won't find this kind of a definition anywhere. We are forcing a definition because everything has to be tightly defined, like in mathematics, okay, or in physics, so that you have the concept is very clear and you don't confuse it with anything else, okay. So how will we, and it has to be an objective definition. You see a lot of definitions which are used in law, in finance, which are not objective. You've seen your great capital asset pricing model, which is full of subjective exogenous variables, okay, and even the endogenous variable is subjective. So cost of equity is also a subjective, in the sense, how would you know what the actual is, right? So you can't even actually evaluate that model, because if you compare it to something like, let's say, if somebody is predicting next quarter's retail sales, if you have a model in which the endogenous variable is next quarter's retail sales, then with the passage of time you can get that actual data. With the passage of time, after 6 months or so, you will have what the next quarter's retail sale was as time passes, right? That's objective data. Okay, it'll come out of the Retail Sales Federation or whatever. Are you following what I'm saying?
Yes, sir.
So if you're building a model which has an endogenous variable like next quarter's retail sales, one of the things you should notice is that yes, this endogenous variable actually can be observed and it's objective. Like if I predict rainfall, tomorrow's next day's rainfall in Delhi, that's also an objective entity. We can get the data from the Met Office. So after 6 months, we can evaluate what was the actual rainfall versus what was the prediction. So when you look at models, we've had this discussion before. Okay, we are just going into this because I'm trying to give you a tight definition. Okay, so you'll see that finance is also replete with cases like this, like the capital asset pricing model. Cost of equity, when you're using it as an endogenous variable in this determination model, do you realize it's not an objective entity? It's not an objective quantity. How will you see what the cost of equity actually was? How will you see what it actually was? So you predict something for some period, but then there's also the question of what was the actual. Like I predicted $2 billion of retail sales for next quarter, but it turns out the next quarter actually it was $1.5 billion. Okay, so you can say that your forecast was off by $500 million. At least you can say that. At least the model is such that the endogenous variable is objective and you can actually say that. You can measure the forecast error. Are you following what I'm saying? Whereas in the CAPM, you can't actually measure, because how will you know what the cost of equity actually was for that period? When you get into that, again, you will have to get into either you do a survey of various people, what did they use, but that is also not objective, because your survey is not complete and different people have different views and you're averaging it. So it's a highly unsatisfactory method. So when you're looking at any model, you should ask these kind of questions. Look at the exogenous and endogenous variables. Are they objective? Can you objectively get the data? Right? Are you following what I'm saying? So these kind of questions. So here we are trying to define it in a very tight and objective kind of way. Okay, so we are saying that a floating rate loan is, I'm not writing it in full English sentences. Loan tenor, okay, exceeds the period for which interest rate is, well, again, I was going to say periodically reset. Okay, set and reset. Okay, you see how this definition is very specific. You can apply this to this situation. Okay, this is being written in your notes, so you have this. You don't need to write it down. It's in your own session outline notes. Okay, right. So what are we seeing in the five-year loan? In the case of a 5-year loan, and the interest rate is being reset on a 3-monthly basis. 3-month LIBOR essentially means when you're looking at 3-month LIBOR, not 1-month LIBOR or 6-month LIBOR, it means it's an interest rate for 3 months. Okay, so what will happen to this 5-year loan? When you take the loan, your certainty with respect to interest outflow is only for 3 months, because at the beginning of the period you set the rate. Just like when you invest in a fixed deposit, you can see the rate today. What are you going to get for 6 months? You can see that rate. Okay, what are you going to get for 3 months? And based on that you invest. Okay, and the bank pays you the interest at the end of the period. Okay, if it's not a very short term, then if it's a very long term deposit, you can take periodic interest payment and all that. But let's take a simple deposit of a 3 month. The bank pays you the interest at the end. Similarly here, you will set the interest rate at the beginning of the period, and you will pay the interest at the back end. Okay, so this will be, say, paid in arrears. Okay, it's set in advance and paid in arrears, the interest, which is normal normal, basically. Okay, we're just using fancy language too. So are you able to follow this? So anytime you have an interest rate which is basically being reset, usually multiple times within the tenor of the loan. So you have a 5-year loan, but the interest is set only at a time, is being set only for, I can probably improve this language a little bit. Loan tenor exceeds period for which interest rate is set and reset. But you get the idea that the loan tenor is bigger, and the period for which the interest rate is being set at a time, okay, is shorter than the loan tenor. So that immediately introduces what we call floating interest rate risk, because 3-month LIBOR can start really rising very rapidly. Okay, if you look at charts of 3-month LIBOR, you'll see, if we can dig up some rates here, will take us some time. Actually, we may get it in our friendly neighborhood charting system, which contains everything actually. Let's see if they have 3-month LIBOR. No. Let's see. What do we have? Euro yen 6-month LIBOR futures. Yeah, they have some long. Anyway, I can't recognize any of these except the euro yen. Okay, never mind. So the point is that basically LIBOR also moves around quite a bit. Okay, so we'll try to give you. Let's say if I can find the where is the Fred chart? Yeah, so we have the Fred chart. The Fred this is a very good chart for those of you who are interested in doing economic. You get a lot of Indian data also on this. Okay, this is the Federal Reserve Bank of St. Louis, so you can read their publications as well. These are all very reliable sources. So if we look at interest rates and we try to look at 3-month, I just want to give you a interest rate, LIBOR rates. Okay, let's look at LIBOR rates. And 3-month London interbank offer rate, okay, which is a LIBOR. Okay, let's see, this is from 1986. Yeah, okay, that's fine, till 15 hours ago. So let's do this. So we are trying to understand what is meant by interest rate risk. So maybe we are going a little bit slowly, all right, but at least you'll understand. Right, okay. So now you can see what's going on here. Okay, this is only from 86. That's why it's not showing the long cycles. But anyway, can you see this? This is the movement of LIBOR. Okay, so it's gone all the way from, actually it was even higher than this. It was about 18% and all, I think, in 1980. Okay, so the point is it's coming down all the way from 18% or so in 1980, all the way down to almost zero. Okay, this is where the central bank started cutting after the 2008 crisis. You can see this sharp period of drops in interest rates, the short-term interest rates. Okay, this is where you see the central banks cutting rates aggressively after the crisis hit, after the financial crisis hit. Okay, and then this thing is reflecting the Federal Reserve raising rates, because this is a dollar LIBOR. Okay, if you look at a yen LIBOR, you'll get a different kind of picture. Okay, because the yen LIBOR has not gone up at all. This rise in the LIBOR here reflects the Federal Reserve has been raising rates ever since Trump came into office. They have been raising rates quite aggressively. I think they raised it 8 times. Now they have cut a couple of times, 2 or 3 times they've cut. Okay, so that you cannot see here as well. So whatever the Federal Reserve, because LIBOR, 3-month LIBOR is a pretty short-term interest rate. Okay, so it will closely track the central bank policy rate. It won't be exactly identical, because there's a difference between a short-term rate of overnight to 14 days, which the central bank is targeting, okay, whereas this is the 3-month rate, but there's not that much difference between a fortnight and 3 months, right? So it will tend to closely track this. So you can see this rise of LIBOR now is reflecting the Federal Reserve's raising of interest rates. You've been following that. The US Fed has been raising rates aggressively since Trump came to power. Okay, so so this is what you see. The point of this chart here is, even though it's only from 1986, you can see that the LIBOR rate moves around quite significantly. Okay, so, and usually loans are in very large amounts. Okay, so that's why now this is what is meant by interest rate risk. So if you, in this particular part, you can see mostly it's coming down, but there are still periods when, say, from here to here it did go up, right? So if you are caught in a situation where you take a floating rate loan here, okay, and then the rate starts moving up, then you have a problem, because your interest outflows are certainly tending to increase a lot. So every company has a budget, so they have a budget for interest outflows also on loans, right? So this will throw everything out of gear. because interest rates are rising rapidly. Short-term interest rates are rising rapidly, so your interest liability is increasing quite a lot. Is this clear? Are you following what is meant by interest rate risk? Okay, so this interest rate risk arises on the typically on the floating rate loans, which is basically the way to think about floating rate loans is the period for which the loan is interest rate is being set and reset periodically is shorter than the tenor of the loan, and that's what creates the risk. If you have a 3-month loan on 3-month LIBOR, there's no risk, because you know at the beginning of the period what your interest liability is, because the loan is only 3 months. The risk really comes from the fact that if you have even a 6-month loan against 3-month LIBOR, then again you have a problem, because the 3-month to 6-month rate you don't know what it's going to be, right? So here you can see that
after 3 months the interest rate amount would be the rate at the last day of the 3 months.
Yes.
90th,
yeah.
Whatever.
So again, yeah. So against the 3 month, at the end of the 3-month period, you will have another LIBOR setting, which will apply to the next 3 months. Another 3-month LIBOR setting, because the loan has been documented as being against 3-month LIBOR. So they will look at the LIBOR setting at the end of the 3-month period.
So it's only converted to other LIBOR.
Which other LIBOR? Huh?
I mean, on the first 3 months, if we have taken the floating interest rate.
Yeah.
So on the last 90th day, on the 91st day, it will be converted to another floating interest rate for the next 3 months. It's not converted to fixed interest.
No, because it's a floating rate. But effectively, see, if you have a 6-month, let's assume this is 3 months, this is 6 months, this is 9 months, this is 12 months. Okay, let's assume. So obviously, at the first, if you have a 3-month loan against 3-month LIBOR, there's no problem, because the rate is set at the beginning and it applies at the end, and that's it. There's no uncertainty. The problem of risk is basically when there's uncertainty about the cash flow. Okay, so here, but if you have a 6-month loan, you against 3-month LIBOR, your 3-month LIBOR initial first 3-month period, the rate is set at the beginning like this. Okay, so this you pay at the end over here, but again at the end here you reset the rate. You will again look at the 3-month rate, 3-month LIBOR rate for the next 6 months and next 3 months. So that rate you don't know when you're standing here. That rate could have, anything can happen in 3 months. Okay, so that rate, that's where the risk comes from. Okay, is this clear? A conceptual way to think about a floating rate loan, definition of a floating rate loan. Alright, so that brings us to the continuation of this. So we have basically just dilated on the discussion we had yesterday about the key risk factors. Okay, so just to quickly recap what we have done. So now you understand why there is additional, in addition to the points, the risk factors pointed out yesterday on the currencies, the yen and the Aussie. You also have an interest rate risk factor on this, on the dollar loan, because it's a floating rate loan, which you can see from the case. In the questions of the case, you can see it's a floating rate loan that introduces interest rate risk. Okay, so typically the way you would manage is, now let's also try to briefly understand the Eurodollar futures contract, because we will try to discuss it in the case if we have time. Our priority is going to be these contracts, which we are actually going to use for trading. All right, so I hope you guys have already started making yourself familiar with these movements. What is going on in gold, what's going on in copper. If you go to the CME website, you'll find a lot of fundamental information also. The objective of this project is that as you are trading, managing the hedge book, you should learn about these instruments. These are all very mainline commodities, mainstream commodities. So any knowledge you derive about any knowledge you pick up on the copper market or the gold market, it's all very useful for your overall training. Okay. So on the CME website, you'll find a lot of information about these markets, fundamental and technical information. So you can train yourself to get familiar with forming views on these markets. All right, and you can use this, and you can use other charts also. I'll try to give you other charts, but this, our friendly neighborhood charting system, this is quite versatile. It charts almost everything. Okay. All right. Okay. So we were discussing, let's go back to the Eurodollar futures contract. You read up on the futures contract. You have to. So the other objective of this project is that through the you have to make yourself familiar with the specifications of these futures contracts. So everything, I can't spoon feed you everything in the class. Okay, in the class I'm only covering the basic conceptual aspects which you need to understand. Okay, to be able to grasp what is going on. But then you guys have to do a lot of reading outside the class. You have to basically familiarize yourself with the contract specifications, try to understand the products. Okay, this is all new for you. So the way the Eurodollar futures works is, why do you think this says 91.1150? Okay, if you look at the contract specs, I'll just show you how to where is our I think I put that into the futures note. So let's open the futures note. I think I've put the futures also into your no, you already have that in your let's put that into the futures note. So we have the links here. We're going to open the, do you understand this problem? What are we trying to understand here? Can anyone explain what this means? 98.1150, let's say it's 98.1150, the euro dollar futures. This is the rate for 3-month euro dollar futures expiring on December 16th, which means through this contract, you are betting on what the LIBOR fix will be on that date. Okay, maybe 1 or 2 days here and there, you have to read the settlement procedures, but approximately around that date. So what are people doing when they are using this futures contract? They are using this futures contract to express their views on what the cash market 3-month LIBOR euro dollar fix is going to be in London. Every day there's a London, these are called fixings. Okay, these rates that come out, these are called fixings. So if you ask somebody, like, show me the, if somebody's asking you, show me the euro dollar fixings, 3-month euro dollar, US dollar, USD, show me the USD euro dollar fixings. That means he wants to know all the maturities for today, what were the fixings. So these rates that finally get published, okay, those rates are known as the fixings, which you will see here. You can see some delayed data. These guys, like every exchange, they're trying to make money by selling their data. Okay, so they will give you some data, but they'll give you some delayed data. You can find some links to delayed data over here when you read. I'm sure they'll give you some, they've given you the methodology as well. All right, so you'll find some delayed data. So he's looking for that essentially. So this are you following what is going on in this contract? You are supposed to use this futures contract to express your views on what the on December 16th, what is going to be the cash market fixing for 3-month US dollar deposit, euro dollar deposits in London. Are you following? Yes. Okay. So what is going to be the euro dollar deposit fixing in London for 3 months? Okay, that is what you are betting on using this futures contract. So if you think this futures contract, if the level of the futures contract is too high relative to what you think will happen on December 16th, then you will sell it, and then otherwise you will buy it. Okay, so that's how it works. But why is it 98.1150? By now our page should have opened. So let's open this and understand why this is. So we're going to spend a little bit of time on the euro dollar futures contract since we started on the, what happened? What is the problem? There's a sound coming from, maybe this thing is on. It's off and it's still coming. Okay, all right. Can you understand this euro dollar contract? This is one of the reasons why. Okay, so this is. It had to be on, that's why it's making this noise. Okay guys, now try to understand this. Okay, what is the contract unit? Remember, everywhere the unit is being given, and how is the contract being quoted. So you see the price quotation part. The contract unit is 2500 into this contract IMM index. IMM stands for International Monetary Market. This is a very old division of the CME where the currency futures first started. Okay, so this is what IMM means. So what is that? So understand, the contract unit is like in the case of crude oil is 1,000 barrels. Okay, in the case of copper, it is some 2,000. We have to see what the copper spec is, but it's some pounds, some amount of pounds. Okay, 625 or something like that. So here you see the contract unit is being defined. This is the size of the contract. One contract size. Okay, just like in US equity options, one contract size is 100 shares. Okay, so here the size of the contract is 2,500 into this index. Now what is this index? The index is now defined as 100 minus R. Okay, 100 minus R, and so 100 minus is clear, but what is R? Okay, R is what? Look at this. Can you read it on the last bench? You guys can read on the last bench? No, I made it even smaller. Now can you read? Now can you read? Okay. Now you can read. Now what is R? Try to understand this. What is R? Because it says 100 minus R. Now try to understand, what we are trying to understand here is Why is this euro dollar futures contract, now that you have a broad idea that the euro dollar futures contract is being used to bet on the future fixing that will occur in the cash market for deposits, for euro dollar deposits in London for 3-month US dollars. What is going to be the fixing? That is, what is going to be the rate that is fixed on that date, on December 16th. Okay, so we're not there yet. So why is it showing as 9811.5? Surely that can't be the interest rate. It can't be 98%. Okay, so let's try and understand why this is showing this way. Now try to understand. So if the quote is 100 minus R, okay, so what is R? Now you can see typically how the settlement happens. Okay, third Wednesday of the contract month. So let's see what this December 16th must be Wednesday. Is it a Wednesday? Monday. Yeah, so they have the for spot settlement. Okay, so you'll take the rate on this day, but that will apply for a deposit starting from here. This is how the deposit just like the spot market in foreign exchange. Okay, so you have the rate for this period. It will apply to a deposit which the interest rate will start accruing from here. Okay, that's why you have the 16th to 18th. All right. Okay. So the fixing will be done. The fixing will be done on the 16th. Okay, so now read this. Now try to understand why this R is whatever is the 3-month rate. Okay, so you're speculating here. The 3-month rate is unknown. You're speculating through this. So what are you doing? You're actually you're expressing a forecast for the 3-month rate. Okay, through the euro dollar futures price. So if I think at this point of time, if I think the euro dollar futures price is too high, I will sell it. If I think it's too low, I'll buy it. But too low, too high relative to what? Relative to my forecast of what the fixing will be on 16th December. Okay, so let's figure out what the market's forecast is at this point. Since the market price is 9811.50, okay, we'll just take it as 50. All right, we'll ignore the offer side. If the market price is 9811.50, what does that mean? Okay, let's go into one of your calc files. Maybe we can make a new okay, we can just do it in the futures thing. So it's 9811.50. all right, so if it is 98, notice one more thing, it's 9811.50. okay, so it's 98.1150. okay, so it says that it's actually 100 minus R, the contract. So the R is the euro dollar rate. Okay, so this has to mean that my forecast for the euro dollar futures contract is 100 minus 98 point thing. That means this is my forecast. Are you following? Not my forecast, is the market's forecast. Okay, are you following what this is? Okay, so the market is forecasting at this point of time that the euro dollar fixing in London, the cash market euro dollar fixing in London for 3 months on December 16th is going to be 188.50. okay, is this clear? All right, so if you think that the true value should be higher than this, if you think the actual futures contract is going to be higher than this, what will you do? Let's say if you think that actually the fixing is going to be 1.95, okay, suppose that's what you think. Okay, that's your view based on what you studied. You went to Fred, you looked at the 3-month euro dollar deposit chart, and according to you, the fixing on December 16th, based on your view of the market, is of this 3-month of this chart, right? Based on your view of this. This is what we are forecasting. Can you see that? Yes. 3-month LIBOR. Based on your view of 3-month LIBOR, you think it's actually going to be fixed at 195. Okay. If it should be fixed at 195 according to you, okay, this is forecast based valuation. Once again, we are doing a fair value calculation, forecast based, because it's based on nothing but my forecast. All right, so my forecast is 195. Then the true value should be, the fair value of the futures contract actually is, this is how you trade the euro dollar futures. Okay, so you form a view. You can see once again how this is very critical for interest rate management. When you actually go into a corporate treasury, okay, and start managing floating rate risk, one of the ways, the cleanest ways to do it, and the euro dollar futures trade for many months. Okay, if you see here, if you look at the quotes, where are our quotes? Contract specs. Okay, we put it like this. If you look at the euro dollar futures quotes, they trade for many years. They trade for years basically. You'll see euro dollar contracts. Now look at the euro dollar contracts. They are trading for many years actually. You'll see so many, and there are all kinds of market terminology. Can you see at 19, 20, December 19, Jan 20, Feb 20, March 20? You're able to bet on what the fixing will be in each of these. So in Feb, March 20, you're betting on 16th, 2 days before the third Wednesday of the month. Because the 16th has come about because third Wednesday of the month is the rule. Spot settlement of third Wednesday of the month, so you have to go 2 business days before that to see which day's fixing you're betting on. Are you following?
Yes.
Third Wednesday of the month in December is 18th. So spot settlement 2 business days before is 16th. So that means in the December contract you're betting on the 16th December fixing. Everyone is following? Yes? Okay, Ritesh, you're following? Okay. So similarly, if you go to June 2020, third Wednesday in June, whatever it is, two business days before, not 2 days, 2 business days. Okay, 2 business days before. Okay, that's the fixing that you're betting on with the June 2020 contract when you're betting on this. And how do you play this contract? You form a view. You go to this. You look at the charts, you form your fundamental views, whatever it is. Maybe the Federal Reserve is going to cut rates or hike rates or whatever in between. Because remember, US Federal Reserve rates will have a big impact on LIBOR because the maturities are quite close together, about overnight to 15 days. And this is like 3 months, so not much difference. Okay, so they'll be quite strongly affected. You take a view on what the LIBOR fixing is going to be. Okay, you look at the market, you find that the market's estimate of the LIBOR fixing is 188.50, but your view is that the actual fixing is going to be, let's make it even more egregious, let's make it 2.15. Let's say your forecast is that the LIBOR is going to be fixed at 2.15. According to you, then the fair value of the futures contract, again you see here you're doing forecast based valuation. Okay, very simple crude model, but you're doing forecast based valuation just like you do for stock valuation, Gordon growth model, etc. Same kind of model. This is also a model, right? Because there's a mathematical relationship, okay, between inputs and outputs. So you have a forecast 2.15 based on the way this contract is calculated. 100 minus 2.15 should be the fair value of the futures contract. So you find the fair value of the futures contract according to you is 97.85. Okay, so now is the market overpriced or underpriced relative to fair value? Overpriced. Okay, so when the market is overpriced, when the market price is higher than fair value, what do? You sell. Okay, so this is how you play views on interest rate, short-term interest rates with euro-dollar futures. Okay, this is a very important, because this is part of our case discussion. This actually, we've already had our case discussion on part of the discussion, not the entire discussion, because there are other ways to manage these risks. Okay, which is to look. So you should start reading when you're talking about more discussion on managing risks. You should read in your folder. You will find in your case folder. You'll find there's a technical note on swaps. Okay, so on swaps, basically on capital market swaps. This is the one on swaps. Okay, so on capital market swaps, which includes interest rate swaps, currency swaps, these are other ways of managing, and in particular you can also manage this risk through interest rate swaps by swapping into a fixed rate. That discussion is also there in the other question in the case, which is over here. If you see, when we come, another discussion of interest rate swaps will come up, because the CEO wants to swap this loan into a floating rate. Okay, this is another important question, another decision problem. Should they do that? Just like you can go from floating to fixed through interest rate swaps, okay, which we have not discussed. I'm just giving you a preview. I'm just saying that there is this thing called a cow, but you don't know what a cow is, but I'm saying that there's something called a cow. Okay, later on I'll show you what a cow is. Okay, so it's like there's this thing called an interest rate swap. Okay, so you can use that to move from fixed to floating, and you can use it to move from floating to fixed effectively. We'll see those transactions when we discuss these questions in the case. But the point is, the other way, that's one way of managing interest rate risk, but another very clean way of managing interest rate risk against specific floating rate fixes is like this, by using euro-dollar futures. Is everyone clear what we have just discussed? Very important. You have to understand what the euro-dollar futures contract is. Very important contract. One of the most important short-term interest rate futures contract wise, it's the most important contract in the world. because the US dollar is the most dominant currency, the most dominant capital market. So euro dollar 3-month euro dollar futures, okay, interest rate futures. So you understand now how the system works, and you're able to connect it to all the theoretical frameworks you studied earlier. Price, compare price to fair value, same thing. And this is actually forecast based fair valuation. It's not CRA. There's no arbitrage here because you're taking a risk, because you think it's going to go up to, the fixing is going to be, you think that the fixing is going to be 2.15. Who knows? The fixing actually might end up being 1.75. No one knows. Okay, so you're taking a risk. There's no CRA going on here. Okay, so there is no true arbitrage. So it is forecast based valuation, just like you have in stocks and projects and all that. All right, so is everyone clear now how the euro dollar futures contract works and how you play the euro dollar futures contract? And this is one way. So if you had, say for instance, if you had a loan that was coming up for repricing, now put yourself in the shoes of the treasury manager and a corporate treasury manager. If you had a floating rate loan on the corporate's books, which is coming up for repricing on 16 December, this we have taken a very short-term focus. Assume that there is not that much. Assume that actually 16 December is very far away. Okay, because you can see how many contracts exist. It just happens that I've called up the 15 December. To show you euro dollar futures, I've called up the 16 December contract. Okay, but actually you can see from here, you can see how far down you can go. Can you see that? It goes on and on and on. Okay, there's not much trading happening here, but up to September 2022 you can see is already actively trading. And this is not even a market hour, because not even Frankfurt and Zurich have come in. This is not even real markets. When the markets actually come in, you see the same page in New York time, then you'll see all this stuff is all actively trading. Okay, so you can see how far out it goes. So you can have a very long-term interest rate floating rate loan, okay, just like our 5-year loan in this example, and you could be selling futures contracts against each of these maturities to manage your risk. But you'll have to take a view also in the first place. You have to take a view. If you're going to trade the March 2025 contract, you have to go to the 3rd Wednesday of the month, go back 2 business days, okay, and then that day's fixing is what you're predicting. So you have to take a view on that day's fixing. What will be the 3-month euro dollar fixing in London on that day for 3-month euro dollar interest rate deposits? Okay, what will be the interest rate fixing on March 2025? And then you'll go through the same process that I showed you here. Okay, that you will see that the market is quoting some price. You can already see some price here. Okay, maybe that is not active. It's unchanged, but you can still see a price. No, there's no price given here. Okay, whatever. Say you do it for September 2024. You see some price here. This is the market's forecast. That includes a market's forecast. So 100 minus this is the market's forecast for what the fixing will be. And then you form your own view, and based on where you think and then you'll figure out whether the fair value, whether the futures contract relative to your view, your estimate of fair value. You followed what we did here? Yes. Right? I saw the market's price, futures price, that includes a forecast, that implies a forecast for cash market fixing on December 16th. Okay, and I form my own view on the forecast for cash market fixing. Okay, I form my own forecast basically for the cash market fix. So basically my forecast is for a higher LIBOR than what the market is forecasting, and I compute the fair value of the futures contract if my forecast is correct, forecast based valuation. My fair value is lower than the market price, so therefore I'm selling. Is everyone clear? Can you go through the entire, are you able to follow the entire logic of risk management here, interest rate risk management through this contract? Okay, so good. So we've had this one discussion on expanding on our discussion of key risk factors. Okay, so we have now identified the key risk factors. So let's quickly go through once again. Who's going to tell us? SG1. What are the key risk factors quickly on the asset side?
Gold, copper, WTI.
Okay. So prices for market prices for gold, copper, and WTI oil. Fine. Very good. Okay. Liability side. What are the key risk factors? So dollar yen exchange rate. We will actually manage it by looking at the dollar yen, because nobody really looks at the dollar yen, because when you're taking views on the dollar yen or the yen dollar market, you usually look at it as a dollar yen chart. That's what is the most actively traded segment of the market. Okay, all right. So we will look at it as, so here is the yen dollar or the dollar yen exchange rate, whatever, we'll just call it dollar yen exchange rate. Okay, even though yen is the base currency in the futures contract, and this is the Aussie US exchange rate. Okay, and then the third risk factor is the 3-month euro dollar LIBOR. Okay, 3-month euro dollar LIBOR interest rate. Okay, these are the 3 risk factors on the liability side. Okay, so we've figured this out. Now, so quickly to recap, what have we done yesterday? So yesterday we have covered risk books. Everyone be quiet, I don't want to hear any talking. There's some talking going on, some noises are coming through. Okay, so what are the, just to quickly recap what we have followed, please make sure you follow what is going on, otherwise you will get totally lost. Okay, make sure you get some learning out of this case. Okay, this time we are spending on the case, you should get some learning, and you'll be able to understand many aspects of corporate treasury risk management and how it differs from running a speculator's book, how the running of a passive risk book differs from the running of an active risk book, which you are already familiar with in your previous 2 projects. Okay, so we have covered risk books. Okay, and we covered what is the basic concept of a risk book, what are the different types of risk books, active and passive risk books. You've seen that. Why do we call them passive? Because they don't want to speculate on prices of particular commodities, but by being in the business of mining and exploring those commodities, they are forced to have some risk. To those commodity price exposure. Okay, because they have to carry inventories. So are you following this logic? Why it's called passive risk? Because they're not actively taking the risk, but on account of the business they are in, they are exposed to those market risks. Okay, yes. Okay, so risk books and the types of risk books, and then we have covered key risk factors. Okay, right, any doubts so far? Okay, so let's go on to the next question. The next topic that we have to understand is the question that is being asked by the CEO is, so key risk factors. When we come to key risk factors, I have to understand one more thing, that this is a very important way, this is a very important skill to be able to identify. It's not very complicated to be able to identify the risk factors, because even when you're, like, you've heard of this designation called risk manager. Okay, in many situations you have a risk manager designation, whether it's in a corporate treasury setting or it's in in the active risk books, the speculator side. Okay, on the market making desk or on a directional speculation desk. Okay, and asset management houses or on bank trading floors, the one designation is risk manager. So one of the first things that you will do as a risk manager is, one of the key tasks is to identify the key risk factors, because these are like the sources of risk. Are you able to follow what I'm saying by sources of risk? What I mean by sources of risk, that this is a risk book. Okay, and what is causing this to be a risk book? Those particular prices that move around. So these are like the sources of risk. Okay, if I had just had some fixed assets, plant, okay, just some buildings, those are not sources of risk. Those are not sources of market risk on this book, because the price of the building is not going to fluctuate from minute to minute. Yes. Okay, so these key risk factors are the sources of risk. So one of the first things that you have to do, whether you're managing, this case is a discussion of a passive risk book. Okay, but even if you're a risk manager on a bank trading floor, managing foreign exchange risk or managing interest rate risk, okay, even then, one of the first things you'll have to do, once you understand what books you are responsible for, the first thing you have to do is look at the book and see and identify what are the key risk factors. Okay, identify what are the key risk factors. And in this case, we have given all spot based key risk factors, but you could also be managing an FX options book, in which case you will have additional risk factors like the eyeballs, because the eyeballs moving around will affect the prices of risk of options. Okay, so the first point is that this activity of identifying the risk factors is one of the first things you have to do as a risk manager. So now you understand what needs to be, where you need to keep an eye on, what you need to keep an eye on. All right, okay, so we have covered these. Now we go on to our next question, which is the CEO is asking, what are the underlying positions? Okay, now underlying position here, when we talk about, I'll just write the small clarification in your running notes. Okay, so some of the notes will be in your running notes, which is so I think this is already covered in your general notes. let me put this down here. Okay, let's go to your general note on okay, so let's go back to underlying position. Okay, we can just look at underlying position, underlying exposure. Okay, so position and exposure we are using interchangeably. Okay, if we say Air India has a position in crude oil, it's the same as saying that Air India is exposed to the prices of crude oil. The meaning of being exposed means it's a sense like if you have a house with a balcony which is not covered, so the balcony we'd say is exposed to the elements. Okay, rain can come and fall, all kinds of stuff can fall, so it's exposed. So Air India is exposed to crude oil prices, movement of crude oil prices. It may go in their favor or against you. So position and exposure we use kind of interchangeably. Okay, so we have so just read a little bit about this. Okay, now these guys don't understand that I'm using underlying. Okay, so the keywords here, let me highlight the keywords, they'll help you to understand. Okay, so the first thing you notice that underlying positions. Okay, so I'm very careful of the use of words. So if I say underlying position, that means it's a type of position. Okay, so if I say BBA student, that means it's a type of student. Okay, so positions can be what type? What are the two possible types of positions? Long and short. Okay, so that means the underlying position, if I ask you this question that the CEO is asking, what are the underlying positions for each key risk factor? Okay, the answer can be only either long or short. It can't be like blue, black, gray. Okay, so it's either long or short. So, but you have to figure out which one that is. Okay, so it's underlying is always discussed with respect to a market. Okay, in fact we should write this as always whenever we say market, because you never see a market in isolation. It's always a market instrument combination. Okay, you understand what I mean by this? That, what is this? What is this? This is dollar yen prices? Yes, but that's not sufficient. That you're not giving all the information that you could. These are spot dollar yen prices. Are you following? Okay, so these are dollar yen prices, these are spot dollar yen prices. So now you are giving a market instrument combination. Okay, if you remember when we discussed markets initially, I said to you that you never see a market price of any in any market. You'll never see a market price that is disconnected from an instrument. So when you are seeing a market price of some market price, it is always some market instrument combination. That is, if you are seeing a dollar yen price, this is, well, people will loosely say it's the dollar yen price, but actually what they should be saying is that it's a spot dollar yen price.
How do you know it's spot?
Because I've given the ticker to make sure that it's spot, because it's not futures or forwards, and on this platform you don't get forward prices. Okay, but the point is that this is the spot price. If you can see here, this is the futures price.
Yes.
Because this maturity today is what, 6th of December?
Yes.
And so today if you do a foreign exchange deal, that will settle on Tuesday, which is still not 16th of December. Okay, and if you see, we can actually look at futures prices when we can look at further forward prices for futures, for yen futures, and in particular especially for the commodity futures. Okay, so the point to emphasize here is that this is a spot price. Okay, and these are futures prices, right? If you remember this, we had discussed, this is also an important point to understand, that you never see a market price that is disconnected from the concept of an instrument. Whenever you see a price, it's always the price for a market instrument combination. Are you following? If you see, like you're seeing here, you're seeing yen, spot dollar yen prices, you're seeing spot Aussie prices. Okay, you're seeing spot euro prices, spot cable prices. All right, any price always is the price for a particular market for some type of instrument. There is no concept of price which does not include the idea of some instrument. Are you following this simple idea that we have to understand? So whenever we write markets, okay, actually what we should be writing is market instrument combination. You can also get a price of dollar yen value cash. Okay, you can get that price also, but that is the price of dollar yen value cash. This is the price of dollar yen value spot. Okay, this, if you invert this, if you want to see it like this, you invert this and you'll get the prices of dollar yen for value 16th December. Okay, or actually spot 2 days out of 2 days away from 16th December. Okay, is this clear? All right, so this important idea we had already discussed earlier, but you need to reinforce that whenever there's, so that's why when I'm writing this concept here, I should write it, I had written it only as a market, but actually whenever we say market, what we really should be saying is market instrument combination. Everyone understand this language now? Okay, because it's dollar yen spot, dollar yen futures, so it's a market and instrument. Market is dollar yen because there are two assets, US dollar and Japanese yen, and it's an instrument because it's either options or it's spot or it's futures or value cash or forwards or whatever. Okay, so there's no concept of price delinked from the price concept of an instrument. Okay, all right, so it refers to the type of exposure will be long or short, that we have already understood. Okay, that an entity will have. Okay, so we are always discussing the entity's underlying position. What is Norway's underlying position with respect to crude oil? Okay, so that will be the what is the answer to that? What is Norway's underlying position with respect to crude oil? Yes, what is it? Any answer? Norway, you know what Norway is? So what is Norway's underlying position with respect to crude oil? Okay, we've discussed that. Okay, I'm just giving, so the point I'm trying to emphasize here is only this, that what is underlying position, it is obviously type of position, so it's long or short. Okay, it is always discussed with respect to some market instrument combination. Okay, so I'll ask you what is Norway's underlying position with respect to crude oil. Let's say I just mean spot crude oil. Okay, or it could be, but ideally I should say with respect to spot crude oil. Okay, so I should always mention a market instrument combination, so it's a type of position that is clear. All right, because you see it from the long position, long or short. Okay, right, now so passive risk book, this idea is already there. Now let's understand. Okay, now this logic is all given in your books, but in your notes. Okay, but let's understand the logic. Let's play with this for a while. Okay, before we look at the answers, look at the technique. Okay, let's play with this for a while. Let's forget about Norway. Now let's ask ourselves, what is magma's exposure with respect to, okay, let's maybe we should do Norway once. So Norway is an exporter of oil or importer of oil? Exporter of oil. Okay, so very big exporter of oil. So now my question is, what is Norway's underlying position with respect to crude oil future, say crude oil, spot crude oil? Long. Who said long? Mehak. Okay, so why? Give her the mic, give her the mic. Is the question clear? We are now trying to understand, because remember, one of the questions in the case is the CEO wants to know what for each KRF. We've already identified the KRFs. Now the CEO wants to know for each KRF, what is my underlying position? Is it long? Is it short? That also we need to be clear about, right? We can't say it's just either long or short. Okay, so now we are asking this question, but to play with that idea, to understand the concept of underlying position, we are asking you this question of what is Norway's underlying position with respect to spot crude oil? Mehak says it's long. Why? No, I have been continuously saying oil. Not they have, yeah.
Since they're exporting oil, so that's why they're selling it.
So?
To other countries,
so it's long. Okay. All right. Anybody else has a different explanation?
Short.
Short. Your answer is short. Okay. Why is it short? Okay, guys, please pay attention here. What is Tarun's answer? Tarun is saying it's short.
Yeah.
Norway's underlying position with respect to crude oil, spot crude oil. Okay, we'll just say crude oil. I don't want to keep saying spot all the time. All right. So you're saying it's short. Why is it short?
So because they are the producer.
You agree with the view that Norway is a net exporter of crude oil?
Yeah.
Okay, fine. Then go on. Why is it? Okay, quiet. Be quiet. Yes.
As they are exporters,
1 minute.
so they will sell the crude oil.
Okay.
And not buy.
Okay.
So, it gives us a short position.
Okay, and now based on your convincing answer, Mehak has also changed her view. So you changed your view.
confused between long and short.
Have you changed your view?
No, sorry, but I got confused within the term of long and short.
How can you be confused about long and short as a finance student in the third term, in the third course of the year? You don't know what is long and short.
But so long and short is the
1 minute, guys. Be quiet. So yes, Mohak, well, now let's clear that confusion if he has any confusion. Do you have any confusion about long and short? What is the technical definition of long? No, if you go back to your notes and see, technical definition initially,
The price is going to increase.
price of what?
underlying asset.
That's not the term we use. What are the two terms we use for the market, for the two assets in a market?
Base asset and terms.
Asset, yes. So now can tell me once again what is the technical definition of long?
Base asset. Base asset.
Yeah, so complete your sentence. So I can complete Pulkit's sentence. What he's got the concept right. The correct definition, which includes all scenarios, is long means you have taken a position through which you are betting that the price of the base asset will appreciate. Okay, in terms of the terms asset. That the base asset will appreciate and the terms asset will depreciate. Your position, position is such that it reflects a view that the base asset will appreciate and the terms asset will depreciate. Long definition, but it is very important to understand. This shows that your concept is clear, because for everything we don't have any kind of loose definitions. Okay, we have everything is very tightly defined. Are you able to follow that the definitions are very tight, very precise? What does it mean? That it means that you are, with respect to the base asset, you are making a bet that it will go up. The price of the base asset will go up and the terms asset will depreciate. Is it clear to everyone? That is the long definition of long position. Now Mehak is clear?
Yes.
Okay. Now go back to your point. Bharat is also adding to your view. What is your answer?
So my answer is they are going long, but
They are not going. We are not asked. They are not going anywhere.
their
We are
position
asking
is long.
what is the position.
yeah, their position is long.
Net position
I
is long.
think they are the exporter of.
You agree with the first view that they are net exporters?
yes.
Okay. Okay.
But I think they are exporters of the product, so they want to sell their products on a particular level of the price.
Okay.
If they are going short, that means the market price is.
They are not going anywhere. They are. What is the current situation?
Yes, if their position is short,
Yeah.
then their view is that the price will fall in the future of the base asset.
Okay.
But if the main exporter of the particular product has a view that the prices fall, then the consumer will also are not ready to pay high prices for their product.
Okay,
if they
fine.
go long,
So I'll just stop the discussion. Anybody else wants to say anything at this point? So I'll just, because we want to save time also. Otherwise, this is one of the problems of interactive discussions, right? That we spend a lot of time, but it's good. But Bharat is the closest to the answer. Okay, that the right answer is they are long. Now try to understand what the logic is. Okay, how will you figure out? So first you have to have some contextual knowledge. So if I ask you now, what is Saudi Aramco's underlying position? Saudi Aramco is also a net exporter. Okay, their exposure is going to be long. So let's take the example of Saudi Aramco. They're also like Norway on the same side. Okay, now why do we say that they are long? Okay, so now let's understand. Now that you have the context, you need some contextual knowledge. You need to know that Norway is a net exporter, that Aramco is Saudi Arabia is a net exporter. Okay, so now that you have the contextual knowledge, if the oil price goes up, does Saudi Arabia make money or lose money? They make money. They're making money relative to the current market. Okay. Yes, everyone agrees. Okay. Now, if the oil price goes down, what happens to Saudi? Are they making money or losing money? They're losing money. Okay. Now go back to long and short. What do you understand of long and short? Okay. Now between long and short, which of the positions has this kind of characteristic, that if the market goes up I make money and if the market goes down I lose money? Is my question clear?
Yes.
Make sure you understand the logic. Don't memorize anything. We are trying to understand what is Saudi Arabia's position with respect to crude oil. We're trying to learn the logic of how to understand the underlying position for any entity. It requires some contextual knowledge that Saudi Arabia is a net exporter. That much you have to know. Alright. So given that, now we ask ourselves, if the oil price goes up for any market, so in this case we are discussing oil, if the oil price goes up, we see that they make money. Then if it goes down, we see that they lose money. Then we come back and based on our knowledge of long and short, we ask ourselves, okay, between long and short, which type of position has this kind of characteristic, that if the market goes up, you make money, and if the market goes down, you lose money? Which one is it?
Long.
Long position behaves like that, right? Long position will have this kind of property. Similarly, you can flip it around. If you look at now, let's talk about India. Okay, what is India's position? This position with respect to spot crude oil? Yes? Who will tell us? Aurora? What is India's position with respect to spot crude oil? Short. Why? Give him the mic, give him the mic. Everyone followed the logic I gave you? You're not supposed to memorize anything. You should understand the logic. Okay? Because the logic is fairly common sense logic. Okay, 1 minute. Now we are quiet. Now let Aurora answer. Why?
Sir, when price goes up, we lose money.
Okay.
And when price goes down, we make money.
Okay. And complete the answer. I'm like a computer. I don't understand anything. Yeah, I'm not able to follow your answer. You have to complete everything logically like you're talking to a baby or a computer which doesn't understand anything. Otherwise, your answer is not complete. You have to get into the habit of giving complete answers. Yeah? What is the completion of the answer? So what does that mean? So why should it be short? Now, second part of your answer. Okay, so the second part of his answer should have been that he has given the first part correctly. So it is only a short position that behaves in this manner. The long position does not have these characteristics. Only a short position has these characteristics, that when the market goes down you make money, and when the market goes up you lose money. That was the second part of your answer. So you have to get into the habit of giving answers like you're talking to a computer. Everything has to be spelt out from the very beginning to the very end. That forces you to think in a very logical manner, because many times we human beings have a tendency to skip through. Oh, that is very obvious. It's obvious to human beings, but it's not obvious to computers. So when you're teaching yourself some concepts, you should always force yourself to think in this manner. It will strengthen your thinking processes. Okay. So is everyone clear now? Now you understand? Yeah.
You also told us that when you gave the Banco's example, that the hedge position would be that of the short range.
That will come to later. That you're going far ahead now. Let's first understand. We have to first make sure that the underlying position is clearly understood. Is this clear? We have not gone to hedge position yet. Okay. So underlying position is a type of position. Now we have to be able to figure out with some contextual knowledge what is a given entity's exposure, what is a given entity's underlying position with respect to any market instrument combination. Is this clear? We've gone through the exercise. Anybody has any doubts now? Everyone is clear, Kaneka? You followed the logic? Yeah? Okay. Alright. Okay. So now let's go through to our case and quickly go through the underlying. Yes, Tarun, what is it?
I'm saying we have to lock into the position.
Yeah. Alright. Okay. Now we are going to start from the very beginning. Surbi, what is Magma Resources? What is their underlying position with respect to gold?
Underlying position.
Magma, we'll just call it Magma. What is Magma? Now we are going back to the case. So, what is Magma's underlying position with respect to gold? Give her the mic, because she'll have to give an explanation also, whatever her answer is. Yeah, 1 minute. We'll have to go around everybody and ask people. Yes? 1 minute, guys, please be quiet. Be quiet, I need to listen to the answer. Yes, the answer is?
So long.
Gold is long. Why?
So because it is on the asset side.
Okay.
And
Yes.
it has limits of 2500, which is
Units is not relevant to your answer. As long as it's more than 0. If it is more than 0, then there is some risk. Okay. So yes, you're not able to complete your answer. You're saying it's long.
Yeah, I knew this part that it is long because it is on the asset side and is on the.
Yes. Quick Bonvita quiz contest. We have to move on. Okay, let's give it to Mehak. Yes.
So they have a long position because if the market is going up, I will make money. If the market is going down, I will lose money. So, according to this, since it's a mining company, so it will be a long position.
Okay, so second part could have been a little bit better. You should have talked about the fact that it is only a long position that behaves like this. Okay, so you started off well by saying that, by noting that it's on the asset side. Okay, so these are inventories. So that means they have that if the prices go up, they will make money. If the prices go down, they will lose money. Okay, so then the second part of the answer should have been that it is only a long position that has these characteristics and not a short position. Is this clear to everyone? Okay, so quickly we'll go through quickly now to save time. Next, what is the position in copper? Underlying position, Magma's underlying position with respect to copper. Anjum? Yes? Don't murmur. Tell us, give her the mic. Maybe we don't have time for the mic. Okay, underlying position is long.
Yeah, so because it's an asset side and base asset is going up and
What is the base asset in this market? No, you're not confident. Copper is the base asset, but you're not saying it confidently. Copper is the base asset, and what is the terms asset?
US dollars.
US dollars. Okay, so you have to be more confident. So copper is, and so therefore, if the price goes up, they'll make money, and the price goes up. Same logic. If the price goes down, they'll lose money. All right. Same for you oil. I'm not repeating that. Okay. So make sure you understand everything, every step. Yash, are you following? Okay. Okay. Next is now. Okay, this is a little more complicated. Okay. Now what we are going to do is that we are going to discuss, although in this case the loan is in yen terms, okay, and the contract that you're trading is going to be the yen futures contract, which is inverted, okay, which is yen as base asset, dollar as terms asset. But to make your life more complicated and to make it more realistic, because nobody in the world actually takes views on this kind of yen dollar exchange rate, everybody looks at this rate, okay. So I'm going to make you trade and make you think of the exposure in terms of dollar yen, and then you will be taking your hedge decisions. You'll be executing your hedges in a yen futures contract. So that'll be more complicated. So that'll be a better test for you guys. That'll be better training for you guys. Are you following what I'm saying?
Yes.
That we are not going to think of our dollar yen views in terms of this inverted rate, because nobody does that. Okay. So the dollar yen, the main active market for dollar yen is in spot. That's where the liquidity is. So you will form your views based on dollar yen. All right. And now, so this we have to understand clearly. So is this clear? The first step, although the loan is in yen terms, the yen futures contracts have yen as the base asset. As far as our view taking on, we have already identified the dollar yen exchange rate as a key risk factor. We've already identified that, which means you have to have a view on that. Essentially, we are coming to that. When you put on your hedge positions, everything has to be based on that's why I've told you to start tracking these markets, okay? Because you have to get into the habit of forming a view on these markets. Now we have to form a view on the dollar yen. That's how we're going to proceed. We're going to form a view on the dollar yen, and if we want to buy the dollar yen, okay, if we are going to buy the dollar yen, if you feel bullish on this chart, okay, so it's going to be more complicated. If you feel bullish on this chart, you would have ordinarily bought dollar yen, but you don't get to trade in spot dollar yen. You have to trade yen futures. So if you were buying dollar yen, you would have been selling yen. So then you will go, let's say you form a bullish view on this chart, that is, you're bullish on dollar yen, okay, and then you will go, and that means you're bearish on the yen. If you're bullish on dollar yen, that means you're bullish on the yen, bearish on the yen. Is everyone following this? So if you're bearish on the yen, here, this is the only contract you're allowed to trade, okay? So you will now go and sell this contract. Is this clear?
Yes.
All right. Okay. So this is how it's going to work, because this is how normally you should do it. So it's going to introduce an additional level of complexity into your hedge book management, which is good. More complexity is better because it forces you to, it puts you in a more difficult situation. So your training is better. Yes. Okay. All right. So let's quickly take a view on this. Now tell us what is the underlying exposure of, we are going to talk in terms of dollar yen. So what is Magma's underlying position with respect to dollar yen? You want to look at the balance sheet? I think we should look at the balance sheet. So what is Magma's, question is clear? Underlying position, everyone has understood. What is Magma's underlying position with respect to dollar yen? Short. Okay, Verma, let's give Verma a chance. Verma, what is your answer?
The long.
Long. Okay. All right. So let's test this quickly on the balance sheet. Okay, if Verma is correct, okay, then what should happen if the dollar yen rates, Verma is saying the underlying exposure with respect, underlying position with respect to dollar yen is long, okay, you're saying it's short, okay, but let's see if Verma is correct, okay, let's first see if Verma is correct. 1 minute, guys, be clear, 1 sec, follow this logic, please. If Verma is correct, then he's saying that our underlying position is long. If he is correct, when the dollar yen rate drops, that means if I make it 105, for example, it should show a loss, because he's saying the underlying position is long. So then when the market drops, he should show a loss, and when the market goes up, he should show a profit, okay, which means what's going to happen, total assets and liabilities will not change, balance sheet size will not change, but watch the we don't have a, do we have a subtotal for some, but you watch the dollar value, you watch this cell, dollar value of the yen loan, okay, and the net worth, okay, because what is going to happen if Burma is right and we change this rate to 105, okay, then this figure will go up and this figure will go down, because total assets is not changing, total liability. So what is happening, outside liabilities is growing up bigger, so net worth has to shrink, because total liabilities are not changing. So outside liabilities are growing bigger because the dollar value of the yen loan is growing bigger. Yes, are you following what I'm saying? And therefore, to accommodate that, the net worth has to shrink, because the total cannot change. A plus B is equals K, K cannot change. If A is now increasing, then B has to decrease. Yes? Okay, so let's do it. Let's see if Burma is correct. We are going to change it to 105. Yes, Burma is correct.
Yes, sir. Please, sir.
Yes, sir. Yes, sir.
We can change it even lower. We can make it like 102.
Yes, sir.
Now you can see
Yes, sir.
net worth used to be 2 million something.
Yes.
Now it's come down to 109. Okay, and market value has also gone up. It was 2 something. I think it has gone up beyond 2. Okay, why did this happen? Let's quickly understand. Okay, your time is up, so I won't hold. We'll continue in the next class. But please make sure you try to understand this on your own. Then I'll explain it once again in the class, but if you don't understand on your own, this is a slightly more complicated example, okay? So make sure you understand it on your own. You can see this, okay? Yes.
I'm just asking that it's written market value frozen.
Market value?
Frozen.
Which closes?
This one. Yellow one. Project start.
Frozen, okay. Frozen means?
It only means that the value of gold and the loan value they are same.
No. Market value frozen means that when you start the project, okay, I will freeze the market values on the start date of the project, because I need to figure out, because the way you will be evaluated is what was your starting net worth, because unless I freeze the market values, I can't freeze your net worth. I need to freeze your net worth and capture the starting net worth. Okay, and then I will see at the end of the project, let's say after 3 weeks or 4 weeks or whatever, okay, because you maybe you won't have more than 4 to 5 weeks. So after 5 weeks, obviously these prices will change. Then I'll once again compute the balance sheet with the 5 week later prices. There'll be some different net worth. Okay, so that net worth may be lower than the starting or the higher than the starting net worth, but it could be either. If it is lower than the starting net worth, that means the underlying positions have lost value, okay, on a net basis. And if it's higher, then the underlying positions have made value. But in the meantime, you are also running a separate hedge book, which you can't see here. So you are running a hedge book here by trading in all these futures contracts, right? So when you are running a hedge book here, your goal is to make sure that you offset the losses in the underlying position. That's the question that Shrishti was asking, that how does the hedge position work, which is anticipating what we are going to cover in the future, that So this objective here is to, that's why you have to take a view. Like for instance, as we have established, you are long dollar yen. Okay, we have established that you're long dollar yen. So if you feel that the dollar yen is going to drop, that means the yen is going to appreciate. Okay, so you're worried about this. This will affect your underlying position losses. It will increase your losses. So what you're going to do is, if the yen is likely to rise in value, you will go ahead and you will buy these yen futures contracts. Yes, so that now you're doing all this buying, all this trading in the TWS will happen in your hedge book. So you have the hedge positions and the underlying positions. Underlying positions you don't touch, but you watch them. You see what the KRFs are. You watch the KRF markets. You take a view. If you see now, you see the dollar yen as a KRF. You feel and you know the underlying position is long. So now, if you feel that the dollar yen is likely to go down based on your view, so the yen is likely to appreciate. So you're going to lose money on the underlying position. So to offset that, you will buy yen futures contracts on the hedge book. So the losses on the underlying position in the yen future on the dollar yen loan, okay, on the yen loan, those will be offset by the profits you make on your hedge position. Are you following?
Yes.
That's why we have the concept of total position. Total position equals underlying position plus hedge position. So we will look at your total profit based on PNL on underlying, PNL on hedge position. So if your view is correct in this case, you will not lose any money on a net basis, because all the losses on the underlying position will be made up on the profits on the hedge position. Is this clear? This is the logic of hedging.
So when you ask the normal question, should we have answered
Okay, 1 minute. She's waiting for. Let's follow a queue. You have a queue number. Okay. Yes.
So when you ask the normal question, should we have answered that the position will depend on the value of crude oil in international market?
No. Position does not depend on that. The assessment of the underlying position is not dependent on the value of crude oil.
If it's depreciating, won't we say the crude oil would be short?
No.
They have to make the profit.
No. You have not understood the logic of the underlying position. See, if Norway is a net exporter of crude oil, okay, so they are just like Magma in the sense that they have to carry some inventories. They are like a producer of crude oil, so everybody has some inventory. They have reserves underground. Those reserves also have to be valued. There's a valuation of reserves also, right? So all that is connected to the market price of crude oil. So all of Norway's, not all of their assets, but a significant chunk of their assets are in crude oil, okay, in whatever form, okay, either underground or already packed into barrels, okay. So a significant chunk of their assets is in crude oil. So the exposure is long because all those assets, their value will drop if the market price of crude oil drops. Yes, just imagine here the same thing. It's just like, see, imagine this is Norway. They have some inventory of crude oil, some underground reserves of crude oil. Everything is valued based on the market price of crude oil. Alright, so if we make this drop, 1 minute, let me just do control Z, right? I want to take it back to the original price. Yeah, that was the original price. So otherwise we'll lose track of that. So if I now drop this price from $57.93 to, let's say, $40, okay, what will happen? The dollar value of this will drop.
Yes, sir.
Okay, total balance sheet will collapse.
So they should be short on the. So they have to make
That
profit.
you are also doing the same thing as Tanya. You are going far ahead into the hedging strategy. We are now trying to understand only the underlying position. Don't go ahead a few steps right now. Try to understand the underlying position.
Formed on the basis of the view we have on the.
No, 1 minute. It's an underlying position, which means what is the natural position that they have on account of the way they are as an exporter or just wait. Maybe once we explain hedge position, you understand.
So then they're forming underlying position. They won't take into account the market. They won't look at the chart, oil chart.
No. They also have to look at the oil chart. If they're to the extent that they're doing any hedging,
they will form the opinion that the oil is appreciating or depreciating. And on the basis of that, they will form their opinion. So that's why I'm saying that if the oil is depreciating, so they will have short, or they will be short on the oil.
That's what I'm saying. You are going ahead to the hedging strategy. We haven't gone there yet. At this point, what is the question we were discussing? We are only discussing the question about the underlying position. We have not yet finished. We have not yet finished our discussion. What we are trying to do at this stage, when we have to end the class, is we are going to each key risk factor and we are asking ourselves, what is the underlying position, which means what is the natural position? What is the natural position with respect to crude oil, with respect to copper, with respect to dollar yen, with respect to the Aussie? Are you following?
Okay, so if they continue to be long on oil, so won't that be I think it would be bad for them.
No. I think what you do is just wait.
Are they oil exporter? If they are not exporting, they are just buying and buying. So
no, they are not buying. 1 minute. You're again making the same mistake. Same mistake that Bharat was making. He was not making a mistake, but he was using the wrong words. He was saying they are going to do it. We are not talking about they have done. We are not talking about anything they are doing. We are saying as we look at Norway, as they are standing still, not moving, what are they? Long on crude oil or they short crude oil? The answer is they are long crude oil, because if the price of crude oil drops, they will make a loss because all their reserves, all their inventories will be revalued lower to a lower level. Are you following?
Yes, sir.
So the underlying, think of it as a natural position. Underlying position is like a natural position. So later on when we discuss hedge position, then you are going far ahead. No, you are going far ahead into what they should do. That we have not gone there yet. We are only discussing what is the underlying position. What's the point? You are getting confused because you are going further ahead. So at this stage we are trying to understand what is their natural position. That's all. Nothing else. Yeah? Clear? Okay, once we have, okay. What is yours? Not related to this, but related to net. Then, any technical question? Okay, so tell me, that we can also record.
I have read that SEBI has changed that payment in spot market. We can the transaction should be in 2 business days.
Okay.
So now SEBI has reduced it to 1 day because of the Carby issue scam, exchange scam. So that won't be considered as TOM because you said in TOM.
Yeah, but there are some exceptions already. So good question. So the general idea behind the spot is 2 business days beyond the transaction date. Okay, the settlement. But there are already some exceptions, like in the foreign exchange markets. When you look at US dollar Canada, okay, if you look at US dollar Canada exchange rate, that rate when you trade dollar Canada, that settlement is 1 day later. Although you still call it spot dollar Canada. Okay, that is 1 day later. So usually it is. There are some countries where India was anyway planning to move shorter and shorter to settlement. So some countries have T+3 also. So it kind of fluctuates around T+2. You remember T+2, T+0. So it generally most of it is T+2 on spot. But in some, as I told you, in the dollar Canada exchange rate, spot dollar Canada, that value actually is T+1. Okay, because of the convention, because there's no need to give them so much time because New York and Toronto are all in the same time zone, right? They're in the same time zone, so it's not like New York and Tokyo or something, so you have to give them time. They have already closed by the time these guys open. So that anomaly is already there. So it is kind of, the way to think about spot is mostly it is T+2, but there can be some exceptions. Okay? So they will still call this spot equity trading. They're just trying to reduce the settlement period, which they were anyway planning to do from before. They had that idea.
So they don't use TOM term?
No, they will not say TOM. TOM is generally a term that is used mostly in the foreign exchange markets, but technically you can use it for any transaction which is valid tomorrow. But here I guess we will continue to call it spot. Okay. So if you want to think about these settlement periods in a more sort of robust way, which is not affected by these kind of rule changes and nomenclature, the best way to think about it is T+0, T+1, T+2, So you ask the market, what is it? What is your settlement? Is it T+1, T+7, T+1, T+3? What is it? So that is a better way to go about it, because then you avoid these nomenclatures, like these words like spot, which can have different meanings. Like spot dollar yen is T+2, but spot dollar Canada is T+1. So there is a little bit of a confusion. So the other way to think about the spot is that spot is roughly around T+2. Most of the markets, spot markets, will be T+2, but there are some exceptions. That's it. Like,
So when we were discussing fiat currency, I had this doubt that some currency follow dual
Let me
currency.
watch my
model.
battery, 1 minute. Because my battery runs down.
So,
24, yeah,
when we were
okay.
discussing fiat currency, so I had this doubt. Some currency follow dual currency model. They have their home currency and they also have the foreign currency, which is I think they allow this in the domestic markets. So I think Zimbabwe has Zimbabwe dollars, also South African rand. So I think they.
No, in that case, they are actually, no, those are both, I don't know what the situation is in Zimbabwe, I don't know. But if they are allowing, essentially, it's like, you know, in Nepal,
Nice, Indian rupee.
in
and
Nepal we can use Indian rupees as well.
Nepali rupee, yes.
So those are both fiat currency regimes. Fiat only means that it's just that the Nepalese government is accepting Indian rupees as payment.
So,
Like in most countries when you go, if you are paying in US dollar cash, no one will say no. You go to Indonesia and you can pay in US dollar cash, including Indonesian rupiah, okay? So because US dollar cash, everybody wants to have US dollars, so it's freely convertible, okay? And so it's just, both are fiat currencies, okay? So in Nepal, when you're using Indian rupees, it does not change the fact that the Indian rupee is a fiat currency. The fiat comes from the word, fiat is like an order of a sovereign or a person with a very, a body with a lot of authority, okay? So it's like a fatwa, okay? So fiat is that's what fiat means, okay? So fiat means essentially that this is why is this piece of paper that we have 2,000 rupees, we have a piece of paper and you're saying it's 2,000 rupees, why? Because RBI says it's 2,000 rupees, okay?
so don't you think
It's not like there's gold worth of 2,000
if
rupees.
one currency is strong and our currency, if foreign currency is strong and domestic currency, so don't you think it will create an instability within the economy?
No, I didn't understand the first part of the
So
question.
if India allows, Nepal allows both currency in the domestic market, and supposing that Indian currency is strong and Nepali currency is weak, don't you think it will create a kind of instability to have?
No, there's no instability as such because there will be an exchange rate also between these two currencies, right? There will be money changers in Nepal who are changing Indian rupees into Nepali rupees. So there's always an exchange rate. That's why you have a foreign exchange market. You have all this, you can see all this movement in the dollar yen. Is it creating instability? You saw this movement in dollar yen, okay?
It will create instability when we have too much of dollars in
No,
our
it's not instability, it's instability.
instability.
Yeah.
So it will the environment become unstable when we have too much of dollar in our hand, within our domestic
No,
market.
why should it be unstable? There's no difference. As long as you have a free foreign exchange market, okay? Here you see the dollar yen moving up and down. The exchange rate is moving up and down. So where is the instability?
It's an international market, not within the domestic boundaries.
No, even within domestic markets, why is as long as you have an exchange rate, what is the problem? You want to pay with, suppose the dollar rupee exchange rate, let's assume that if we say this by force, we say it's 1. Then in that case, if something is worth, like if I'm selling you a t-shirt worth 500 rupees, I don't really care whether you're paying in rupees or in dollars. If it is, let's say 2, that means if I have something priced at 500 rupees, you can pay me $250 and I'll accept that. So as long as there's an exchange rate, what is the problem? There's no exchange. Two currencies are accepted as legal tender, right? So in countries which have freely convertible currencies, generally people don't bother with the foreign currencies because many people may not accept it. But in general, there is no problem because if you have a freely functioning foreign exchange market where you can exchange one for the other, then there's no problem. But in most countries, there's usually only one dominant currency and then some other currencies may be accepted. But there's no instability. If you have a free market, there's no instability. Actually, you can say that this is the fact that it is moving. The fact that it is not a constant straight line.
Yeah.
Okay. The fact that it is moving, you can always say this is proof of instability.
There is volatility.
Yeah, there is volatility because there is some change. But that is what the point about the free markets is that by allowing the foreign exchange rate to fluctuate, you are able to accommodate other economic forces. Like if a country has, like what is happening in China, they are facing problems with the tariffs in the US. So what they're doing is they're depreciating the currency so that they don't have to raise prices to US buyers, because the US buyer might object if you raise the price to him. So what they're doing is basically they're depreciating the currency so that the US buyer is able to get more goods for the same dollar, for each dollar. Value of Chinese goods that they're getting is more. Okay? So therefore they're accommodating them in that way. So the exchange rate is a way of adjusting. It's like a safety valve. Like pressure cooker, you have a safety valve which lets out the pressure. So the exchange rate is like a safety valve. Okay, so when there is some kind of macroeconomic disturbance, the exchange rate can adjust to reflect that disturbance. That is why you should have free markets, because otherwise what is happening is you're not allowing the forces to play freely. It's like you're trying to keep a inflatable, you have a life vest and you force it, try to make it go underwater, but then it comes out on the other side. So it's artificial, it's unnatural. Is this clear?
Yes, sir.
Yeah? Saloni, you still have a question? Okay.
अरे 160 करोड़ है 200